it's not very wise to transfer Bitcoin to pay for anything. I mean, if you were to say to me, I can pay you in Bitcoin, it doesn't make a lot of sense because the transactions are slow. But if I had highly appreciated Bitcoin, I would be accelerating a shorter or long-term capital gains bill in order to pay you. And so the only way that I would pay you in Bitcoin would be I would take $100, I would buy Bitcoin, and then 1 minute later, I would transfer the Bitcoin to you so that the basis in the Bitcoin is equal at the time I acquired it and the time that I transferred it. So I think that this is a vestige from the first decade when there were a lot of retail users of Bitcoin and before they understood the law. But the law has been very clear in the U.S. since 2014. And any institution, right, any high net worth individual, any corporation, any institutional investor understands that you acquire this stuff, you're going to hold it. Now, I'll make one more point. It doesn't make any sense to pay for anything in Bitcoin for two reasons. The first reason is because it's a taxable event. Mm-hmm. And you're a fool to accelerate taxes on your own person by a decade. The second reason it doesn't make sense is because it's a long duration asset that's deflationary, which means it's likely to go up in value. It's been going up 150 to 200% a year every year for a decade. So why would you pay $1 million in Bitcoin to buy something which is going to depreciate in value when the $1 million in Bitcoin may very well double 1, 2, 3, 4, 5 more times, right? So it's a long-term investment asset. A much wiser course of action would be to borrow money against Bitcoin. If you have an appreciating asset, never sell it, finance it. And if the asset's appreciating at 20% a year, and if the interest rate is 5%, then it's pretty obvious what you ought to do is keep the asset, pay 5% interest, because the tax bill on money that's borrowed is zero. So you could live off of your borrowings against your appreciating asset for the rest of your life, without ever paying the asset back, without ever paying the loan back, and without ever paying any income tax, and without ever paying any capital gains tax in the U.S. Other tax regimes may be different, but in the U.S. right now, that would be the treatment.
And I hope my audience is paying attention, because that's exactly, the brilliance of you and what we try to teach here on the channel about. That's why I'm a long-term buy and hold real estate investor, because you're not paying the taxes on the debt. And that's how you can build wealth appropriately and using it that way. So don't be just selling your Bitcoin and buying Ferraris with it. Don't be a knucklehead with it.
If you desperately need a Ferrari, you're better off to borrow the money against the Bitcoin. Like you can be rich with a Ferrari, a yacht, and a jet. You need to have borrowed the money against a tangible asset, which is going up in value as the money supply expands, in order to keep and pay for the Ferrari, the yacht, and the jet.
Exactly. Are there any alternative coins, any altcoins that you invest in or you're bullish on when you look at, I don't know if you look at any of these that are out there right now? You're looking at Cardano or Ethereum. Are you just strictly?
No, they're all ventures, right? Bitcoin's the dominant crypto asset. Ethereum is the dominant crypto application. You can divide the entire universe into some segments, and Ethereum is competing with Binance Smart Chain and Solana. That's very competitive. They're very complicated. They're very centralized, much more centralized than Bitcoin. They have to be centralized because they need to run on proof of stake networks because they need the speed. Mm-hmm. So proof of stake itself is orders of magnitude more centralized than proof of work, because you don't have these sprawling networks of miners with their ASICs everywhere on Earth sucking up energy to keep any one person from getting control of the network. So Bitcoin is like the dominant winner of sound money These other things, they're just very risky. They could crash. One could win. One could lose. Ethereum doesn't even run on proof of stake yet. So, basically you don't know when they turn on proof of stake, the entire thing's not going to go in some bizarre way, right? What'll happen? You don't know.
Interesting.
So let me say it a different way. If you're a crypto investor and you run a venture capital fund and you want to make investments with high risk, high reward, and you want to study it and you want to take the risk, then you can trade in those things. But in my opinion, they're 100 times less lucrative over time and they're 100 times more risky. So it seems like it's a 10,000 to 1 difference. I wouldn't do it, but other people do it, and it's probably good for the industry because it markets the industry, right?
Right.
And they're venture capitalists. They have to do it. Like, I'm not gonna, I'm not gonna tell them not to do it. It's like this is one risk tranche. This is a different risk tranche. If you're super smart and if you guess, will it be Binance Smart Coin or Ethereum, or maybe it's both, maybe you trade. But, when you get into that, you get this question of, well, when are you going to take money off the top? And when are you going to diversify? And are you going to be in it forever? I tend to think I would prefer to invest in things I can hold for a decade, if not 100 years. But there are plenty of people whose job is they're venture capitalists. And the venture capitalists are betting on things where they think there's a 90% probability it'll fail. But they think that they'll get 100x return if it hits. So it's a different thing, right? So I would say it depends on your portfolio of money. Like are you investing someone else's money, your own money? Are you a VC? Are you a private equity investor? Are you a saver? Converts their money into a strong currency. An investor manages a portfolio of risk. I buy some Apple, some Facebook, some Google. They've all got risk. A trader manages a portfolio of risk derivatives. I'm guessing, I've got options in Apple, and I think that Apple is going to beat on the next quarterly release.
Right.
It's not even a portfolio of risk over a decade. It's a portfolio of risk over 90 days. Or it's the second derivative of risk. I'm like shorting Apple options against Google options because I think the spread is coming in, and it's something you can do.
Right.
It's just a different thing, right? I'm arbitraging people's risk derivatives, and fine, knock yourself out if you're bored, if it's your profession. But another analogy is like a decade ago, if you bought Apple and Amazon and just held them, you probably would have made a lot of money. You would have made 10 to 20 extra money. Now, if I could go back 20 years or 10 years, would I give people advice about when to buy and sell Apple in the year 2012? Or how to trade Apple options against Amazon? Should you buy or sell Amazon in the year 2014? Can you remember off the top of your head whether you should have bought or sold Amazon in 2015 so you could buy it back cheaper in 2016, or did it? Yeah, by the way, if you had, Jeff Bezos was at war with Donald Trump before the election. And so what's the worst thing that could happen to Amazon? You would think that it would be Donald Trump getting elected, right?
Right.
But, if you had actually sold Amazon once you know that Donald Trump was getting elected, it would have been the most catastrophic decision in your life, because Amazon stock doubled in the first 12 months after Donald Trump was elected. You understand what I'm saying?
Right.
It's like you're a trader and you know the future, you'll probably still lose money. Because the best thing that ever happened to Jeff Bezos, Jeff Bezos, his greatest enemy got elected president. Jeff Bezos' stock went from like $800 to $3,200. Mm-hmm. Okay, Jeff Bezos got divorced. Is that bad? It should have been bad for Amazon. Didn't seem to be bad. It was good for them. Like all sorts of, it's hard to predict what might be good or what might be bad. If you go back a decade, and if I told you, I think Facebook, Google, Apple, Amazon are good companies, what's your best strategy?